A year ago, nearly 9 in 10 new apartments got rented as soon as they were finished. This May, it was barely 6 in 10. Same country, 1 year, that's the story. Welcome back to Smart Real Estate. I'm Addy Saeed, broker, operator, and your guide through Ontario multifamily market. Solo show this week, so it's just me thinking out loud with you. Here's the through line for today. Everybody's been shouting that we built too much rental housing. I don't think that's quite the case. The data this week tells a sharper story. We built a lot of rental housing at a price that people looking to rent can't actually pay. That's a different problem, and it changes what you should be buying. We're going to talk about the whole chain. Start with CMHC data on what's actually getting absorbed, then the demand side, who's renting and what they can afford, then financing policy and the new supply landing right now, one developer's very public bad, and the one corner of the market that's actually short. And finally, the question that ties it all together. How much supply is too much supply in a market where rents are sliding? If you're a smarty, you already know I'm going to give you the bear case on every one of these. Let's go. So let's start with where it matters most, with the data, not the noise. CMHC tracks something most people ignore: absorption at completion. Translation: when a new apartment or condo finishes construction, did it actually find a buyer or a renter, or is it sitting empty? A year ago, in May 2025, that number for apartments and condos was at 89%. Nearly 9 in 10 units gone at completion. This May, 64%. That's the lowest reading in the entire run of monthly data that they have been collecting. More than 1/3 of finished units are now sitting unabsorbed the day they open the doors. And the inventory for a completed but unsold apartment climbed to 12,829 in May, up from 8,318 a year earlier, roughly a 54% jump in finished and empty units. And here's the honest caveat. 2 things you need to hear before anyone runs with these numbers. 1, this is national data. It's not Ontario isolated. And number 2, and it is important, CMHC have put a notice right in the file saying that they're reviewing the methodology for unabsorbed inventory specifically in Ontario context, and to use it with caution. So I'm not going to stand here and give you a clean Ontario number because the people who publish it are telling you the Ontario slice is under review. What I'll give you is a direction, and the direction is not subtle. Here's why this is the most important slide of this episode. Falling absorption isn't a bubble. A bubble sells everything to the greater fool. This is the opposite. Supply is arriving faster than demand can take it down. That's an oversupply signal, and it is the foundation for everything else we talk about today. So a couple of key takeaways. So apartment and condo absorption at completion fell from 89% in May 2025 to 64% in May 2026. It's the lowest in the series shown. Completed and unabsorbed apartment inventory is up roughly 54% year over year to 12,829 units nationally. That's national data. CMHC has flagged the Ontario unabsorbed series as under methodology review. Cites directionally, not precisely. And something worth watching, if the absorption rate keeps printing below 64% in the coming months, that's an oversupply line being crossed in real time. So if segment 1 was the supply side, this is the demand side, and it's the missing half of the story. Rental.ca surveyed just under 1,200 renters across the country this spring. One number reframes the whole debate. 42% of renters are searching for a budget under $1,500 per month. The average asking rent on Canada right now is $2,029. Sit with that gap for a second. Almost half the demand pool is shopping below $1,500. The market is asking just over $2,000, and 70% of those renters say affordability, not supply, not selection, affordability is the single biggest challenge. Now, connected with segment 1, why is 1/3 of the new product sitting empty at completion? Because the new premium purpose-built stuff rents at top of market and the demand is stacked at the bottom. It's not that we built too many rentals, it's we built too many at the wrong price point. The absorption miss and the affordability gap are the same facts seen from 2 different ends. So this is a proprietary survey from a listing marketplace, and I'm treating it as sentiment, not gospel. And one number I won't oversell: 36% of Toronto renters expect rents to fall in the next 6 months, highest in the country. That's renters' expectation, not a forecast. People who want rents to drop are telling a survey they think rents will drop. Useful color, not a prediction. Underwrite on cash flow, not on hope. So a couple of key takeaways. There's a mismatch. 42% of renters budget under $1,500 per month, and the national average asking rent is $2,029. 70% cite affordability as their top challenge, and the problem is price, not availability. The affordability gap is the demand side, cause of the segment 1 absorption miss. So something worth watching: product priced at sub $1,500 and $1,500 to $1,999 bands is fishing where the fish are. Premium new builds, it's not. So a quick reaction segment, but it matters to anyone carrying debt, which is all of us. Canada's banking regulator, OSFI, just cut the domestic stability buffer for the big six banks from 3.5% down to 3. First cut in 3 years, effective immediately. The idea, banks hold less capital in reserve, which frees up capacity to lend. OSFI says that it should unlock hundreds of billions. Sound bullish for real estate. Slow down. 2 honest points here. 1, this is capacity, not price. Your mortgage rate still tracks the Bank of Canada. A buffer cut doesn't move the renewal rate. And number 2, the banks decide where the capacity goes, and OSFI pointed at AI and resources and trade war economy. Nobody said apartments, so don't assume this loosens commercial real estate lending. It might not touch us at all. What it really is a confidence signal. The regulator is stepping back, a marginal tailwind for credit availability. And here's the bear note. A regulator loosening buffers late in the cycle is the kind of thing that looks smart on the way up and questionable on the way down. Whether any of this capital actually reaches multifamily, we will see. Couple of takeaways. DSB cut to 3% from 3.5%, effective immediately. First cut in 3 years, applies to the big six. And this is capacity, not price. Doesn't move mortgage rates, which still track to Bank of Canada. And free capital is not earmarked for commercial real estate. OSFI pointed at AI and resources. So this one's policy argument, and I wanted to handle it carefully because it's one of those most cited economists in the country making a case and not reporting a finding. Benjamin Tall at CIBC argues that rent control is the wrong way to help renters. His case, cap market rents below market and supply shrinks. Developers build less, landlords defer maintenance, and tenants stop moving. He points to New York, to Stockholm with its 9-year wait list, and to Ontario's own rent control history going back to 1975. His alternative, let renters deduct a portion of their rent from taxable income, the way homeowners get the principal residence exception. Now, why does this matter to you as an Ontario investor? Because Ontario exempts a unit built after November 2018 from rent control. That exemption is a big part of what makes new purpose-built rentals pencil. If that ever gets rolled back, and it's a live political question every election, a lot of underwriting breaks overnight. So the policy isn't background. It's a variable in your model. And the other side, I'm not going to just adopt Tal's framing because here's the counterweight. Rent control is popular. It protects sitting tenants. It's politically durable precisely because people like it. And remember the Rentals.ca survey from earlier? 36% of renters say that they'll only consider rent-controlled units, and the other 41% aren't sure. So you've got an economist saying, take rent control off the table forever, and you've got the actual renters treating it as essential risk management. That tension is the segment. I'm not telling you who's right. I'm telling you to underwrite the policy risk in both directions. Couple of takeaways. Tal argues rent control suppresses supply and quality, proposes a capped renter tax deduction instead, his position, not settled facts. An Ontario post-2018 rent control exemption is what makes a lot of new purpose-built rentals pencil. Treat its permanence as a risk variable. And renter demand for rent control, Rentals.ca, directly contradicts the economist's arguments, a genuine unresolved tension. Something worth watching. Any provincial signal on post-2018 exemption would move economics much more than a rate cut would for new builds. Here's a supply story made concrete. Fitzrovia just kicked off leasing at Marlow at Bloor and Dufferin 898 units across 3 towers, the first phase of a much larger Bloor Crossing master plan. Nice project. Adaptive reuse of Old Kent School, family-sized units, full amenity package. But here's a number that matters for us. Per Urbanation, stabilized vacancy in GTHA buildings completed since 2000 hit 5.4% in the first quarter, up from 3.6% a year ago. That's a big move, and Urbanation themselves point to 2 causes, slowing population growth and condo investors dumping unsold units into the rental market. So a premium building opens into one of the most competitive landlord markets in years. From my acquisition seat, this is the live demonstration of everything in Segment 1 and Segment 2. New premium supply carries the vacancy. Lease-up takes longer, concessions creep in. Meanwhile, and this is just a thesis, older stock you bought below replacement cost isn't fighting this fight. It's already full, and the rents still work. So a couple of takeaways. GTHA vacancy in post-2000 stabilized buildings rose to 5.4% from 3.6% a year earlier. Urbanation attributes it to slower population growth plus condo investor rental supply. Completion is structural, not seasonal. And premium new build absorbs the vacancy. Lower bases, older stock is insulated. Vintage framing is our new editorial view. So from a building opening today to a pipeline that won't deliver in decades. The city of Vaughan has approved the Tormont Master Plan in Vaughan Metropolitan Center. 17 towers. One of them is a 73-story, nearly 10,000 residential units across 4 phases. Phase 1 alone is over 3,000 units. It's a transit-anchored, right on Line 1 subway extension. Quite honestly, note on sourcing. I've got this approval confirmed through an architect's own announcement from early June. I could not nail down the exact council vote date independently, so I'd say it's recently approved and leave it there rather than invent a date. The project facts are consistent across the sources. Here's the investor read, and this is the whole point. Approvals are not supply, not yet. This is phased over a decade plus period. It does not move today's rents. What it does reshape is your 5-year and 10-year exit math in that particular node, and it makes a broader point. There is a long lag between approvals and finished unit. The spectacle is a 73-story tower. The signal is the phasing. Watch the phasing, not the headline. So a couple of takeaways. 9,950 units approved across 17 towers. Phase 1 will have 3,294 units, and it's a decade-plus phase in delivery. Approvals are a lagging supply signal. They reshape long horizon exit math, not current rents. An approval is sourced on the project architect's website around June 3rd, 2026. Exact council date is unconfirmed and framed accordingly. Now, a developer is putting his own money where his mouth is, and a claim I want to pressure test. So Brad J. Lamb, one of Toronto's best-known condo builders, is pivoting to purpose-built rentals. His reason, in his word, he can't sell condos right now. He says he hasn't broken ground on a new development project since 2020. Now he's got 5 or 6 apartment buildings in the pipeline he intends to build and hold. And here's the part that connects to our whole episode. Brad says the rental math only works because of the subsidies. Ottawa removing HST on purpose-built rentals and some cities waiving development charges. He pegs Mississauga eliminating development charges plus the HST relief at roughly $300 a square foot in savings. His words, that's the only reason new rental construction pencils at all right now. So let's look at it honestly. Lamb also says that prices are 50% below where they should be, and it'll never be cheaper than now. Maybe. But this is a developer with unsold inventory making a floor call. That's not analysis, it's a position. And it runs straight into our own segment 1 data. He says inventory will clear and prices will rise, while CMHC says absorption is falling, not clearing. I'm not calling him wrong. I'm saying watch the gap between the bottom call and the data. And the real risk he reveals without quite naming it. If a whole sector pivots to purpose-built rentals only because subsidies make it pencil, then those projects are underwritten on policy that isn't permanent. Development charge waivers don't survive a municipal budget crunch forever. And that's not price bubble. It's a subsidy cliff concentration risk. And it's more dangerous because it looks prudent right up until the policy changes. So a couple of takeaways. Lamb is pivoting from condo to PBRs. It says new rentals only pencil on a $300 square foot plus HST development charge relief. That's his estimate. His price is 50% too low, never cheaper. Floor call is his self-interested position and conflicts with the CMHC absorption data. And structured supply is a subsidy dependence. Thin margins on PBR underwritten in incentives that can be clawed back at any time. So something worth watching, any municipal move to restore development charges and verify Mississauga's development charges standards against the city bylaws before relying on the $300 a square foot figure. So segment 8, everything so far says oversupply. This segment is the nuance because oversupply isn't uniform. At a recent student housing summit in Toronto, the panel, developers, lenders, and purpose-built student accommodation argued Canada is short on student beds. University-run residences counts have actually fallen since 2023, and private development hasn't filled the gap, even with high occupancy and steady rent growth. On its face, that's the opposite of what market rate oversupply we've been describing. So 2 things before anyone treats this as a buy signal. Number 1, every person quoted in this is in the PBSA, purpose-built student accommodation business. That's not research. It's a sector pitching its own opportunity. I'm framing it as practitioners' views, full stop. 2, and this is the one that they stalked past. Student housing demand runs on international students, and Canada is capping their visas. Cut the students and the supply gap closes itself the wrong way. So the gap is real today, but it sits on a demand-side policy fault line the panel underplayed because it's inconvenient to the pitch. There was also a claim about dorm configuration lifting GPA by some number of points. No scale, no methodology in the reporting. I'm leaving that out. It's exactly the kind of false precision figure we don't need to put on the screen. The real lesson for your portfolio, oversupply is not a blanket solution across all rentals. Specific demand-resilient niches can stay tight even when premium market rate floods. But always underwrite what the demand actually depends on. And here, it depends on immigration policy. So a couple of key takeaways. Panel claims real purpose-built student accommodation supply gap, falling university residence beds, lagging private development. Number 2, demand leans heavily on international students. Visa caps are a live downside risk that panel underplayed. And number 3 takeaway, oversupply isn't uniform, but niche tightness is only as durable as its demand driver. Everything we built at LIM is free. Head to learninvestmanage.com, sign up, and you'll get an invite to the school community to compare notes with other smarties. No cost, no catch. So we got 3 themes tying it all together. It's not too much rental housing. It's too much priced above where demand sits. That's segment 1 and 2. And then approvals, subsidies, and financing all loosen supply on a lag. Rents are sliding now. So that's segments 3, 6, and 7. And then oversupply is concentrated in new levered premium subsidy-dependent product, not uniform across segment. That's your segments 5, 7, and 8. So how much supply is too much in a sliding rent market? Honest answer first, I can't give you a clean GTHA unit number. And anybody that does is making it up because CMHC themselves flagged the Ontario inventory data as under review. So let me give you the mechanism instead, because that's what you actually want to use. Too much isn't an absolute unit count, it's a rate. It's the point where absorption can't keep pace with completions and rent fall faster than the debt assumption allowed. And in a sliding rent environment, that point arrives earlier because falling rent compress your NOI at the same moment vacancy stretches your lease up. Those two stresses compound, which means the real unit of analysis isn't the market, it's the individual deal's debt service coverage under a stressed rent and vacancy scenario. The market can absorb a lot of supply if it's phased and equity heavy. The same volume becomes too much the second it's concentrated in time and levered on construction that underwritten to flat or rising rents. And here's the part to really sit with. This isn't a uniform risk. It's overwhelmingly concentrated in new premium high cost basis product, the stuff that needs the $300 a foot subsidy to pencil and needs top of market rents to service its debt. That's exactly the cohort CMHC's absorption miss is measuring. Older stock, bought below replacement cost, has a low enough basis to absorb falling rents and still cover debt. And it isn't chasing the marginal premium tenant in the first place. The genuinely dangerous scenario, the bear case, I'll say plainly, concentrated at 2026 to 2028 completion, plus sliding rents, plus the subsidy cliff, all hitting together. A cohort of thin margin projects completing into a 5% plus vacancy, leasing up slowly below pro forma, while development charge or HST treatment shifts onto the next phase. That's not a soft landing. That's a distressed supply event, and you'd see it first in construction financing pulling back, then PBSA, then PBR receivership 12 to 18 months later. So a couple of keys take away on what to do with it. The risk is timing and leverage in premium new build, not rental as a category. Underwrite each deal's debt service coverage, under stressed rents, and extended lease up, not at market-wide averages. Lower basis, older in-place stock is the structural hedge against both the absorption risk and the subsidy cliff. Watch for signals. Absorption rate below 64%, GTHA vacancy past 6%, construction financing pullback, and first PBR, PBSA receiverships. That's the episode, Smarties. The supply is real, but it's landing at a price the market can't reach, and your edge is being on the other side of the trade. If today helped, the tools and the community are all free at learninvestmanage.com. Sign up, join us on school, and we'll see you next week. Addy Saeed is a licensed real estate broker with Remax Gold Realty, Regal License 4735346, founder and general manager of Westcliff Living, and an OSC registered dealing rep. The host may reference companies or entities in which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Property Group, and Finance LLP. Listeners should be aware of these relationships when evaluating any commentary in this episode. The podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decisions. Past performance is not indicative of future results.